Look at what are the areas which are coming under pressure today. Large caps trading at day's low. Today we have a very special interaction planned with two guests today, one on the institutional side and one on the HNI retail side. Gurmeet Chhada of Complete Circle, and we will also be shortly joined by Gautam Duggad, institutional head of research at Motilal, Oswal Institutional Equities, to talk about inflation and its impact on equities, on returns. Why is it important for investors and strategists to keep a track on inflation, and what could potentially do to your portfolio? Let's understand academically first what's the relationship between inflation, interest rates and returns with Gautam Duggad, and then we'll talk about how to protect your capital and returns and your portfolio as well. Gautam, good afternoon. Thank you so much for joining us. Gautam, yesterday the inflation reading in US came at a 40-year peak, but still the market actually jubilated briefly after falling. Last evening, India inflation also came almost at a 2-year high. And lately, the conversations among strategists do indicate that we are in an inflationary environment and hence equities could remain under pressure. If you could explain to us, for the investment management followers, investors, everybody academically, why does this actually be a big worry for equities?
Hi, good morning, good afternoon. Audible? Hello.
Yeah, go ahead, Gautam.
Yeah, okay. So look, inflation is a reality. Years of easy money, easy monetary policies, and which got exacerbated post the pandemic, when central bankers over the world and governments also in the developed markets flooded the markets with a lot of cheap money to provide fiscal stimulus and also to revive, the economies. Now we are seeing the after effects of that, where inflation is trending upwards. And of course, it also got a bit unnerved by the geopolitical situation, which has been unfolding since February. So you have crude above 100 after a long time. And briefly, you saw $140 print also on crude, which was highest after 13, 14 years. And then, of course, some of the industrial commodities has also been rallying, which is creating its own sort of problems. As far as the equity market is concerned, not every inflation print is a bad news. If you go back in the earlier cycle, 2003 to 8, when our markets delivered fantastic returns, I think 25% CAGR from 2003 to sort of 2008, then you would have seen inflation was also trending up. So the linkage with equity market is not so simplistic actually, because sometimes it also conveys that growth is picking up, and which creates its own sort of inflationary, linkages. Secondly, there are sectors which also benefit from inflation, right? Not all sectors suffer from inflation. So commodity producers are actually a clear beneficiaries of that rising inflationary trends. Of course, you will have some segments of the economy which will suffer and will have second and third order impacts as well, as far as corporate earnings are concerned. But when you are trying to look at equity markets and trying to juxtapose this with inflation, it's very easy to get bogged down looking at 6%, 7%. I mean, Ajaya, look at India. 7% inflation is creating so much of noise. If you look at 7-8 years back, we are used to having 8-10% inflation at CPI, WPI print. So it's not as if that we are seeing it for the first time. Why the noise is so stronger today is because your developed markets, which have been seeing 2-3% inflation, have suddenly started seeing 7-8% inflation. Very rarely have we seen India inflation being lower than US inflation. So that's why you're seeing a lot of discussion happening around it. If you, for a moment, keep aside the global economy and just look at Indian inflation comparison from the period of 2003 to 2000, or rather 2005 to 2012 and now. So 6% is the mandate for MPC, between 2 to 6%. The moment it crosses 6%, I think there are some implications that they have to be answerable to. But I don't think 6 or 7% is going to make life so difficult as far as equity markets are concerned. The job of the capital allocator will ultimately boil down to finding bottom of ideas in sectors which either are resistant to inflation and B, are actually beneficiaries of inflation. So some sectors will obviously you will have to relook at, given that if those sectors have a lower pricing power, you may want to rethink whether you want to have allocation to that. Sectors where there is a huge competitive intensity and there is a pricing competition, obviously we'll take it on the chin as far as margins are concerned. We are seeing that happening in the last 2 quarters itself. But I'm not in the camp which says, because inflation is 7%, suddenly all bets are off the book and you have to move out of equities. So sometimes, inflation, as long as it doesn't get into a hyperinflationary spiral, tends to benefit the nominal GDP, nominal corporate earnings. And for companies which have good demonstrated track record of pricing power, it actually serves as a lever to raise longer term margins over a period of time. So if something like manufacturers of goods which are essential day-to-day items, while in the short term for a quarter or two, they might show margin compression, which we are already seeing. But once consumers get used to those prices, then over a period of time, volumes do make a comeback. And we have seen it happen cycle after cycle in the last 30 years.
It's a very good point which you made, Gautam, that we cannot be choosy on inflation. If we want our earnings growth of our portfolio companies, we want inflation, we want wage inflation for ourselves, but we cannot not ask for inflation on items which we are consumption oriented or we are consumers. So inflation actually, there's a positive side to it also, and that also means growth. Let's talk about a little more about the type of companies which are resistant, sectors which are resistant to inflation, actually are beneficiary. For example, financials, if rates go up, some of the high quality CASA franchisee ones, if you could share some sectors which come, just handy on your mind, top of your mind, which are quite resistant, are strong, and perhaps even beneficiary of inflation.
So I concur with you, high quality banks which have higher CASA percentage on their balance sheet, they will obviously reprice their assets faster, and their deposits will obviously, the cost of deposit will not rise so fast. So naturally they tend to be a beneficiary. Secondly, they will also benefit with perhaps some lag if, working capital requirements of corporates go up. It will provide some sort of an upward, push to their loan growth and therefore NIMs. Some companies, even in financials where the CASA franchise is not solid, they may face pressure on margins. The second obvious beneficiaries are the B2C sectors where the market share is absolutely dominant and they have demonstrated track record of utilizing the pricing power which exists on paper, right? So for example, companies like Hindustan Lever, Asian Paint, Pidilite, they've been, they've seen multiple cycles of commodity cost inflation. And we have seen how they've managed their margins over a period of time, say last 10, 15, 20 years. Obviously, in the short term, they will see some impact on their quarterly P&L in terms of percentage margins. But as things stabilize and demand comes back, those prices do not fall much. Once you've taken price increases, unless you are seeing a price war happening in those categories, you don't see prices go back even when raw material prices start stabilizing. So with a lag of some quarter here or there, they tend to benefit, provided you have pricing power, dominant market share, right? Then some of the commodity producers, so for example, oil and gas, metals, they are obvious beneficiaries of this inflation moving up. And then you have sectors like utilities, telecom to an extent, which do not sort of have a very direct negative impact on their margins or profitability just because of general rise in inflation in the economy. What gets hurt, obviously, as we are all familiar, sectors like auto, where the margins are low and ability to pass on the price increases is very diminished. And especially demand has been suppressed for 4-5 years now. So corporates there will be very reluctant and think multiple times before passing on prices. So their margins will remain squeezed for a longer duration of time. Cement, which is essentially a commodity where your pet coke, coal prices have been going up through the roof. There you will see impact happening this quarter, next quarter, maybe even more, depending on where the prices were to stabilize, because their ability to pass on prices to the consumer is very, very limited. And you've seen how competitive that sector is. Consumer durables, again, sector which has been sort of flattish for last 2-3 years in terms of their volumes. They may think again before taking prices, because after 2 years of absolutely battered summer because of COVID first and second wave, this year you are looking at a summer which is looking a bit more normal, and possibly they might want to ensure that their volumes do not suffer, market shares do not suffer. So they may think twice before taking price increases. So you might see continued impact on margins, and given the elevated valuations which they trade at, you would see impact on their multiples also. One general thing we need to be absolutely aware and cognizant of is when your bond yields are now where they are, 7.2, 7.3, maybe they will hit 7.5, we don't know. Clearly, it puts a cap on equity valuations, and therefore you have to be absolutely sure at what multiple you are buying those stocks in such environment, and also be sure of their earnings visibility and pricing power.
Right. Just one last word. Let's scratch that point a little more. In this kind of an inflationary or rising interest rate, however temporary or phased it might be, what happens to high valuation companies where market actually prices them to perfection, or some of the even small and mid cap? How should investors approach that? Is there a case for valuation compression in these kind of times on 80, 90, 100 times price to earning kind of companies? So what are your thoughts there?
Actually, it depends on your underlying earnings and cash flow characteristics. If your earnings are not getting impacted too much and your cash flow characteristics are not diminishing, then possibly you would see time correction happening there instead of a very sharp or a severe price correction. But if your edifice is built on stories and narratives without earnings and cash flows, then obviously when money supply tightens, which we are seeing now, quantitative tightening may start somewhere around May or June, and rates are going up. Only the quantum of rate hikes is debatable, right? So those kind of companies, that trade has been there since October, November, where we have seen a lot of the high flyers without support of underlying earnings or cash flows have compressed, both in terms of their absolute market caps as well as the underlying equity valuation multiples, right? So very few companies can escape the wrath of higher rates, and if your performance is not coming from underlying earnings growth. I mean, look at it, forget individual stocks, look at the market itself. For FY10 to FY20, the Nifty earnings growth was just 6.5% CAGR. And Nifty gave a returns of 8.6 or 8.7% CAGR. I mean, broadly, you can say converged with the underlying earnings growth. Last 2 years, we have seen 15% earnings growth in FY21. And this year, we are going to close at 35% earnings growth, which is the highest since 2004. So 2 years, cumulative earnings are up roughly 52-53%. Look at the market. Market was 12,000 odd, somewhere about January, February 2020. We are somewhere closer to 17,500, 18,000, which is around 50% up. In between, we went down, we went up. But broadly, again, the underlying driver, which is earnings growth, has driven the market performance. So that is what is, will also trickle down to individual companies also. If there is a strength of cash flow and strength of earnings, then irrespective of headwinds and challenges, the companies will find a way to deliver those earnings and cash flow based on their inherent pricing power, and markets will recognize that. This is a period where markets will start separating companies where the edifice is built on just stories and narratives, and companies where the strength of the franchise is demonstrated by the compounding growth that we have seen in earnings and cash flows.
All right, Gautam, thanks so much for your time. Very interesting inputs and also indication on the kind of sector which are relatively resilient and inflationary environment proof. Thanks very much for your time. Let's take a short break on that note. On the other side of the break, we'll get one more market specialist to talk on this subject and how you can carefully craft your portfolio in these inflationary and high interest rate environment. This is a special telecast for making your portfolio inflation proof. Why exactly is it important to have a view on that, so that you can guard your returns from the portfolio and you can structure your portfolio in a way, because these are extreme environment, especially for inflation. US inflation at 40-year high, our own inflation is surging at almost 2-year highs, and by the looks of it, it may sustain elevated levels. And the next specialist we have for you is Gurmeet Chhada of Complete Circle Capital. Gurmeet, for our retail and HNI viewers, Why don't we start by understanding from you the relationship inflation and high interest rates actually have for equities, and why is it important to be conscious of this fact?
So I think it's a very relevant topic and probably very timely, because we are seeing a reversal of rate cycle across, maybe with a few exceptions. So I think there are two buckets here, which is what to do and what not to do. Right? What not to do, I'll start first, because we spend too much time on what to do. Is what not to do is that we need to remember that the discounting rate is now going up, right? So the cost. So let's say US had zero interest rate and the 10-year US was 0.6, 0.7% during COVID period. It got below 0.5 also. There is a different multiple you assign to equity. Now, when the 10-year US bond is now inching to 3%, and same can be applied in India also. Now the 10-year bond is now across 7. That you have to apply a different multiple, which means you can't overpay, just because of hype, just because of pure momentum. So one thing which is not to do is don't overpay, or just invest basis hype or the latest fad in the market. Second, what not to do is to figure out companies where the spending is more discretionary, and the impact will come on both demand and margin, because inflation has two aspects there. So companies which are in consumer discretionary, companies which have less pricing power, companies which just went up because the sector was getting re-rated. It could be financials, it could be specialty chemicals, it could be commodity consumers, right? I think that is not to be done. What is to be done is look at initially when interest rates goes up, it is not necessarily bad for equities, because interest rates go up when the growth is strong. The central bank feels that there is some overheating in few pockets which needs to be managed. So if you look at US, for example, since we keep talking of US yield curve inversion, we had 11 rate hikes in 2003 to 7 in US. And despite that, we saw a good run because the demand environment, the growth was very strong. So what we should be focused on is where do we get a good growth, a strong growth environment, where there is a good demand momentum, where there is good pricing power to pass on these inflationary pressures. Your inventory management, your cost optimization is put to test. So this phase actually differentiates between the winners and not so good performers.
Gurmeet, also, is there a case for valuation compression in certain parts of the market, or even the entire market for that point, that if we remain in an inflationary environment and high interest rate kind of an environment for some period of time, the valuation multiples could also come under pressure?
Absolutely. As I said, suddenly if I am an investor and I am, let's say, getting 7.5% on a 10-year bond in India, my benchmark or my opportunity cost goes up, which means that I'm less willing to pay a higher multiple on equity. So you will always see some derating and valuation compression. In fact, it has already started happening, Ajay. If you see last year, the flavor of the season was API, specialty chemical. Anything and everyone who just commented on specialty chemical went up. And then we saw the huge pressure which came because of raw material prices, solvent, supply chain disruptions. Within that, let's give an example, you saw DBs maintaining margins, in the API space, and all others got, because they started doing Tolnupavir, there was a lot of debottlenecking they did. They have this Kakinada facility which is coming up. So companies do get differentiated. We saw that differentiation in some of the IT companies also, who were able to manage, the wage inflation and attrition better than the other companies which were not so able to do. So and that's the reason you get, let's say, somebody like an Infosys, TCS at plus 30 multiples, and you have some companies even in the large cap which are still at about 18, 20 multiples. So I think that differentiation is happening, and and that's what this is model called dividend yield model, which means that as the bond yields keep going up, the relative attractiveness keeps changing. So that principle has to be kept in mind, that we don't overpay and we don't assign very high multiples to companies just basis what we think is going to happen in future.
In order to find protection and make your portfolio inflation proof, people also start looking for good ideas in high dividend yield kind of companies in these kind of time. Is that a right approach? What are your thoughts on that?
See, I think dividend yield should be a secondary objective. That's my personal view in the portfolio. Yes, it gives you some cushion in terms of cash flows. You have some companies which actually have started doing well. Let's say, for example, ITC is one of the most discussed topics, across various platforms. Does offer a 5-6% yield. But what is happening there is that, we've seen finally some volume growth in cigarettes. We are seeing their FMCG business do well. Because of their agri unit, the integration they have and the ability to manage cost pressure is much better. Obviously also because of the other business like paper and hotel, which were a drag. So it's more business performance. I think dividend deal is always a welcome step. It does help to protect capital. So a part of the portfolio can be assigned to high dividend yielding stocks to ensure that regular cash flows keeps coming, and typically these stocks are they're called value stocks, and they're not very high growth stocks. So, but it can't be the primary objective of the portfolio, Ajay.
Right. Gurmeet, if we were to really look at the universe of stocks which you track, what are the kind of business models which are quite robust, which could actually weather this storm where multiples come under pressure, inflation and hence interest rates also starts looking upward? What are the kind of stocks which one should look at, or even sectors, if you could share some?
There are three mini themes which we are working on. One clear theme is this digitization and this digital economy shaping place. I think the demand environment is extremely strong. I've attended a lot of earning calls. I've attended a lot of forums. Look at, for example, TCS just reported numbers, $11 billion TCV last quarter. Such a strong demand environment, almost $3 billion more of incremental revenue, 10,000 crore kind of a PAT. I think Infosys is likely to report numbers. I was seeing TCS pipeline of 100 million clients, 50 million clients, and so on. Their 100 million client bucket now, they have 60 clients. In 50 million, they have more than 100 clients now. So it's happening across verticals, across segments, and I think we are still in early stage. Also, this business was more on accreditation and certification. Now it's moving into growth and transformation. So pricing is now outcome driven. It's not really dependent on who's the lowest cost bidder. So I think that will continue. So one can create a nice portfolio. You can have some large caps like TCS, Infosys at the top. You can have some good mid cap names like Mindtree, L&T. Then there can be some niche players like KPIT, etc. So I think you can make a nice portfolio in digitization. I also think some of the fintech companies can be added to this. We continue to add 1 lakh demat accounts a day. I think my last count was 8.5 crore demat accounts. I haven't seen $15 billion selling in 2 months and Nifty holding out. I think it's a lot of people who are in the market will tell you that there's a lot of resilience there. So I think this financialization of saving and equity cult, which is growing, I think is a very secular theme. So even players like CDSL and asset management names, insurance names, I think make the cut there. The second theme which we like, I think, is this entire PLI-led, government policy-led revival in manufacturing, and it has various components around it.
All right, Gurmeet, we'll let you go on that one. Thanks so much for your time. In fact, with that, it's a wrap on the show. Hope you enjoyed this special telecast on how to make your portfolio inflation-proof, and you understand how to navigate your portfolio and markets in these kind of inflationary and high interest rate times. Thanks very much for watching. Goodbye.